First of all, thank you everyone for coming. This is really great to see all of you here and really appreciate such a great turnout and everybody eager to learn about credit. Our guest speaker is Dave Sullivan. He has over 20 years in the 20 plus years in the credit industry. So he is the credit guy and will be able to answer our questions and everything that you've been thinking about and wondering about credit. So we're going to start with Dave and he's going to lead us today.
Like you're going to hear other people who are credit experts tell you that you need a mix of credit. That is a bunch of crap. It's even on my handout, only because that's the official line from FICO. All you need is a long credit history. You don't need a mix of credit. Okay, so as long as you have a long credit history, mix of credit doesn't matter. Now, if you have bad credit, maybe mix of credit would come. But I only have one credit card. I have no auto loans. I have 3 mortgages. I am above an 800 score. You don't need a mix of credit.
You just said you don't have any auto loans. Do you hurt yourself? I don't have any auto loans either, and I wonder, do you hurt yourself when you pay cash for your cars and you don't share your auto loans anymore?
Well, if you listen to some people, they'll tell you it does. I'm going to tell you it doesn't. A lease versus own is it looks at it as an installment account. So at the beginning of the lease, it hurts you a little bit more, but as you go through the lease, it comes up. Now, the difference between a lease is sometimes it's a 2-year lease. Auto loan might be 5 years. So as more time goes by with the auto loan, you're going to be better off because you've got more history.
Okay, I'm not clear. You said you have 1 credit card, but previous you said you should have 5?
Yeah.
Okay.
I'm unique. But,
He's the credit guy.
I'm the credit guy. And I'm testing stuff too. I'm, fiddling with the model.
So we should have 1 or we should have 5?
You should have 5.
And all major banks?
That's what I would recommend. You could have 1 electronic store in there if you're going to have 5. But I would recommend.
What if they don't get used? So if they go
You do need to use
them. $14 a month.
Yeah.
just a little bit. There are 2 theories on that. But let me get to that in a second. You had a question.
On credit cards, does it matter what your limit is? How does that relate to what you're actually using and paying all the time?
That's a big part of it. So here's the thing. A lot of people will tell you pay them below 30%, below 50%, below 25%. I disagree with that information, and here's why. Because I've been playing with that one card, I have found that at every 9%, so if you're at over 100% loan to value or loan to balance, then it's like a collection. It kills your credit score. But if you go down to 99%, it's a little bit better. If you go to 92%, nothing. 91, nothing. 90, nothing. 89 gets better. Okay, and then 79, and then 60, and then 59, 49, 30, 29, 19, 9% is the best. So if you pay your credit cards between 5 and 9% every month, keep the balance in, you'll get the best score.
You don't keep the balance.
And if you pay them off 100%, that's
get
against you?
Well, you don't go, it's not like having above credit. Hey, I didn't come up with a model. This is not my model.
It's better to keep $5 on it versus pay it off in full. Is that right?
Well, here's the thing about that. I want to have a perfect FICO score. That's my goal.
Is it possible?
So, yeah. Although it hasn't, nobody's reported on it yet. There are rumors that people. But anyway, here's the thing. I thought I had figured out a way to get up there. I was going to pay my credit card below the balance owing so I'd have a credit on the credit card. Here's what happened. My score went down. So I had a credit on the credit card and I was worse off than if I had 5 to 9%. That's because they look at it like you're not using the credit card. Same thing for an installment loan. Here's another interesting thing about installment loans. Your utility bill is now being listed on your credit report as an installment loan. It's not really an installment loan, but I think they put it in that category in order to lessen the impact on your credit score. So here's what I tell you about installment loans. If you're better off paying off your bills every month. Yeah, I give you that. But if you're trying to get the highest score possible, what you might want to do is prepay down on your utility bill a little bit to keep that balance low, because in the winter, as our bills go up, that can hurt you, and I've seen it happen. So,
Yes. Well, what about that budget plan for the utility business?
well, that's
Does that hurt you?
different. I have not played with that. I don't have, I can't tell you that I've seen that and it's changed. But what you can look at on the trade line is, look at the high balance and look at the payment. If they list a high balance very close to the payment, that's a problem, because you're up here on a high level. Now, we're just talking about the fringes of the scoring model here. You know, we're not at the guts of it. But if the balance is high near the top, that can hurt you. If you're looking for a few points, pay that down. I don't know if you do it on the installment plan.
My husband pays all the bills, but he has our gas bill, I think, on a budget.
Get the same
Gas
bill,
bill.
$88 every
What's the
month.
high credit? What's the high credit on that account?
12 times that payment.
Is it?
It's the average of the.
If that's what it is, then you're fine. I don't know.
After you don't pay off the credit cards every month?
You're better off paying off the credit cards every month from a, sanity perspective. But if you want to get the best FICO score possible, you need to leave between 5 and 9%. And somebody said, well, what if you leave $5 on it? The problem with that is, what I found is FICO sometimes will look at $5 depending on the high credit and say that's not enough. So it's not a percentage enough. It might be the percent might be 0.
So we basically have to pay interest to get a decent FICO.
No, wait.
I'm talking about just peaking, I'm talking about getting to the top.
Well, you know what the purpose of that is? Is that the purpose of all of this is you're trying to show people you can pay things in a timely fashion over a period of time. If you pay your bills off every single month, you're not showing anybody anything. If you leave a little bit and you pay it off, you're showing repayment
Well, you're
history.
good because you have the history. The problem is, it looks like you're not using it.
Right.
So it looks like it's 0.
So, yeah, they want.
So, hold on, I got too much time. You were first. Yeah.
Is that
5 minutes, and then I know it's getting close to 1 o'clock, so you guys can filter out as needed or say and ask some questions. So we put this together here for waiting periods for a loan. The first loan product we'll talk about is conventional financing. So if you just kind of follow the chart, the Chapter 7 bankruptcy requires 4 years from the discharge date. Chapter 13 is requiring 2 years from the discharge date. Foreclosure is 7 years. Short sale, there's a little bit of a gray area right now that we're seeing within short sales, but typically on conventional financing, they do want 4 years, and they are required to do 20% down at that time. You'll notice there's a little star next to a word in our industry that is a little bit frustrating at times, but if someone has extenuating circumstances, and that is defined underneath by death of a wage earner, a long-term uninsured illness, or job relocation, the underwriters will consider after 2 years if they can put at least 10% down to formally apply for their loan. Consumer credit counseling is when someone will go to a credit repair company, and maybe that repair company is managing all of their debts. For conventional financing, they don't need to wait, or they don't need to show a 12-month history of that. For FHA and VA, it is a little bit different. Chad, you want to hit on the FHA and that?
Yeah, so for FHA, so the rules are a little bit less restrictive than conventional financing. You've got 2 years from discharge date on the Chapter 7 and Chapter 13, and then related to a foreclosure, it's 3 years. And then again with the short sale, 3 years from completion, but it is extenuating circumstance.
Real quick, let me just, on the short sale for FHA and VA, it's important to note that we have qualified people shortly after a short sale that have met the extenuating circumstances, that have not waited that 3 years. But it's important that that person has to be current at the time of the short sale. So if they pay on time, I know it's not typical, but every so often we're talking with clients that paid through the date of the short sale, paid on time, and that gives us a leg to stand on.
What if the bank requires you to stop?
If the bank, that's the tough thing, is 90% of the time the banks require them to be late for 30 or 60 days. So again, it's not typical, but we have seen people get through that process paying on time.
How would that impact their score if they're late?
I mean, 1 30-day late could kill them.
Right.
Could really hit their score pretty good.
And then you'll see at the bottom too, for minimum credit scores, conventional loan type with less than 20% down requires a 660. If you have more than 20% down, it's a 620. And a lot of that's just related to the PMI companies. Right now, the PMI companies are not entertaining PMI unless you have that 660 minimum. Yeah.
Your little new flyer says you do no doc loans. People who do no doc loans, is credit score different for them?
So that type of loan is someone that may have a lot of money in the bank that we can, say they have $500,000 in an investment account, and we can set up a distribution from that account. They would fit right into conventional financing credit scores. So if that person can put 20% down, they could have as little as a 620.
A self-employed person, when I moved here, I had to get a no doc loan.
Well, the no-doc loans of old are much different than they are nowadays. So
Is
right now,
the credit score different for those?
no, it would be, it's a conventional loan. And when we say no-doc, we don't, it's, the old stated income, stated asset loans. We're not doing those. Those are not available, but there is something where we can use distribution from an asset account to qualify someone, and that would fit under the conventional loan credit score requirements. Does that make sense? Sort of. I'll sit you down after.
And you'll see on here too, FHA and VA have a 640 credit score requirement. Michigan looks at it as a 620 or higher.
So this timeline chart, we get these questions quite a bit. It's ever changing right now, so these are moving on an annual basis. So this is something just for you guys to have as a reference point. If someone does ask you that question, how long do I need to wait? You can have something to reference. So right now, I think what we'll do, guys, is just leave the rest open for question and answer. If people have to get going, that's fine. We appreciate everybody coming in. So what cookies?
Would a job loss, what if they lost their job, would that qualify as an extenuating? No. It's not.
Down the street,
It's gotta be a relocation.
Yeah.
Cupcakes.
You would think it would be, or we had people that were getting reduced pay.
Right.
And
See if I come
Nor does
That's
the
a
board.
problem.
divorce in the county.
And it isn't working right now. It's gotta be a relocation by the employer.